To build anything that truly lasts, it takes time.
Hi there, let's throw the spotlight on the CPI numbers coming in fresh for the month of June, and you have that flashing on the bottom of the screen as well. Let's take a look at what the numbers have come in to be. June CPI inflation has come in at 2.1% compared to 2.82% in May, a very sharp cool off coming in on the CPI front. Remember, this is even better than what the street was expecting on a consensus basis, given that the Reuters poll was around 2.82% is what we had seen last time. The estimate was around 2.2%, anywhere between 2.2 and 2.5%. 2.5 is what Reuters was estimating. We also interacted with Morgan Stanley earlier in the morning, wherein they were expecting 2.2, but this 2.1 number has beat all estimates and is better in terms of the cool off that we have seen on a month-on-month basis. So you can see that falling trend in inflation and that cool off that we have been seeing. A lot of economists have already said, or they believe, that this could be the best that we see in terms of the CPI print, and we could have bottomed out right now. Maybe the month of July could mirror this, but after that we could see a little bit of a spike up. So what does this mean for our economy? Why have we seen this continuous cool off in CPI? We're not complaining, it's a very good thing for the macroeconomic front, but well, this is the number that we are working with right now. A 2.1% figure is what we are seeing for India's retail inflation. If you take a look at the June CPI rural inflation, that's come in at 1.72% versus 2.59% in May. So a very sharp cool off on the rural front as well. Let's make sense of all of this and much more with our guests who are joining us on board. And let's welcome on board Mr. Saugata Bhattacharya, who is joining us on the board along with our other guests. And Mr. Bhattacharya, we'll begin with you. He's an independent economist who's joining us. Along with that, we have Aditi Nair, Chief Economist of ICRA, as well as Mr. Madan Sabnavis, Chief Economist at Bank of Baroda. Thank you so much, all of you, for joining us. But Mr. Bhattacharya, let's begin with you. Give us your first take on the number that we are seeing, much better than expected. What's your take on this?
Thank you very much for having me on your show. Yes, it is a pleasant surprise because even my own estimate, just like in the street, was anywhere between 2.2 to 2.5. So this is lower than that. And obviously, I mean, this indicates that the Q1 average inflation will be even lower than the RBI's forecast of 2.9% to 2.9%. For the first quarter. And obviously, I mean, considering keeping other things in mind and other things being as it is, the annual inflation might also likely fall below the 3.7% RBI forecast. So obviously, this is very good news. But exactly as you said, that this is probably the bottom of the fall in the inflation rate. And remember, one of the key reasons for this fall is that last year in the month of June, inflation had actually gone up to 5.1%. So that was probably the peak. So the next 2 months, you're likely to see somewhat higher inflation. But otherwise, I think we are in a very good position in India. And given the other global factors that we are beginning to see, I think we are in a very good position in terms of inflation going forward.
Right. So thanks for your first take, Mr. Bhattacharya. Aditi, we'll come to you. Hi, thank you so much for joining us. While we are talking about inflation overall, what's really standing out to me right now is the whole food inflation number that's come in at a negative 1.06%. Is this signaling any risk of deflation in certain categories to you?
Thank you so much. So as we've already heard from Shogato, we did have quite a strong base effect for food inflation for this month. Last year at the same time, food inflation was very, very high, and therefore we were expecting food inflation prints to be very benign in the corresponding months of 2025. In our projection, we had actually built in the headline CPI inflation coming in at 2.5%. So it's a fair bit lower than what we had penciled in, and we had not expected the YOY deflation in food inflation. The headline number for the food index is a little lower than what we had expected. And overall, if we look at how things are building up, so not only is the base very, very high from last year, but in addition to that, we've had an early onset of the monsoon, and we've got Kharif sowing, which is about 11% up YOY. And now, half of last year's Kharif area is already sown. So it's not a high growth on a very small base. It's a high growth on a reasonable base now, as far as the Kharif area is concerned. Of course, with the heavy rainfall that we've seen in the last few weeks, now vegetable prices have started going up in line with what is typically normal, in a seasonal sense for these months. So perhaps the second half of July will end up showing, a higher pressure coming in from the vegetable side. I'm not sure June will be the bottom. I think July headline CPI inflation could be a little bit lower than the June number. And then after that, of course, we will get a sort of gentle slide up in the rest of the year. But I agree, we were already looking at an average CPI inflation of 3.5% for FY26. And I think today's data only reinforces that the numbers are going to come in lower than what the MPC had last indicated.
Right, so that's the take on inflation on that front. But Mr. Sabnam is hi, welcome to the show as well. Give us your sense on the entire data point that we're seeing when it comes to the core inflation, because while all may look good in terms of headline numbers, you have the June CPI core inflation that continues to remain sticky. It's come in at 4.4% compared to 4.3% in May. In fact, the June CPI core inflation of 4.4% is the highest that we're seeing in September 2023. Help us understand, how should our viewers understand this kind of divergence where we are seeing a very significant cool off in the headline number, but you have the core inflation that continues to be sticky?
See, if you look at the headline number of 2.1%, the important thing is that around 46% of the weight comes in food items, and these have been driven by the base effects. So this time we're getting a negative food inflation number, which is of course a positive thing, which means that prices have actually come down compared to last year. But last year, I think the food prices had gone up substantially. So what we're really seeing is that on account of the high base which we had last year, we are getting very moderate numbers right now. Core inflation is something which is non-food, non-fuel inflation. I think this has been the tricky part because it's something which has been showing a consistently increasing trend right from last year. So in fact, last year we thought it would probably go up to 4% and plateau out there, but now we've seen it's gone to 4.4%, which is fairly high. And if you look at what is it which is driving core inflation, it's essentially, if you look at the various sets of goods and services which go there, we see a case of prices being reset based on how the costs have moved. So if you look at the corporate sector, for example, in the last few years, they have not really increased the overall prices because they have been complaining of low demand conditions and high inflation, which means when real purchasing power is low, you also realize the demand for your product is low. So that's one of the reasons why you do not increase the prices. But today, if you look at it, you look at health, you look at education, I mean, the fees are going up, the charges on hospitals are going up, prices of medicines have gone up. So there has been a kind of transmission which is taking place very, very gradually. And this is something which will continue to move in the upward direction. So this kind of an anomaly is going to remain at least for another month or two. And while we could also get an overall headline inflation number in this 2.5% range in July, for the entire year, we are still looking at something in the region of around 3.8, 3.9. RBI has 3.7, we may probably reach 3.7%. So personally, I'm not too excited over this number of 2.1%. And just because in Q1, average inflation is going to be lower than what the RBI has projected, this will probably give us relief by a couple of decimal points. But we will see this trajectory going up. And when core inflation trajectory goes upwards, I think that is something which the RBI will be having a closer look, because there's a lot of pressure saying that should the RBI be cutting rates further, I think they will be looking at core inflation before any final decision is taken.
Okay, so thanks for that take. Mr. Bhattacharya, will come to you. And in light of these numbers, help us understand what the next action by the RBI could be. Given the kind of cool-off we've seen in inflation, are you completely ruling out any possibility of a rate cut going ahead, at least for the near term? Or do you believe we still have some more room for a rate cut?
Well, I mean, this is, again, I mean, Aditi and Madan will probably be able to tell you better than I can. But as Mr. Raghuram Rajan used to say never again. So again, I mean, I don't really know. One of the key things that I have a little bit of a different opinion from Madan on the core inflation part. I think we have, just like I and you think that overall headline inflation has bottomed out in the month of June. I think core inflation again will have peaked in the month of June. From now on, it'll be a gradual slide down in core inflation because the base effect of the last year from July onwards has been on an upward trend. And given the fundamentals of all the prices, whether it be metals prices, oil prices, particularly the prices that you see at the pumps, petrol and diesel prices, etc., we might actually see a cut if petrol prices. I remain much more sanguine in terms of core inflation. So overall, as I said, we are in a sweet spot. I don't really know what kind of effects the various tariffs that are now being threatened. We have already seen the 25%, 50% tariffs on aluminum, on steel, now another 50% on copper. How that affects prices in the US, how that transmits into prices, what impacts that has on the metals exporting countries, exporting into other economies. So there are a lot of uncertainties. So I'd reserve judgment on this. But as I said in the beginning, that I think we are in a good position in terms of where we are in terms of inflation. There is room for cutting rates further. When and how this happens is anybody's guess.
Aditi, would you like to weigh in on that and any outlook on what the next RBI action could be on this front?
Sure. So, we thought that with an average CPI inflation forecast of 3.5%, which was 20 basis points lower than what the MPC had last indicated, that there was going to be room for one more rate cut. And we thought that after the 50 basis points cut that we got in June, that August might be more likely to be headed for a pause and then a cut in October after, the monsoon outturn was very clear. But having seen the kind of undershooting we've got in today's data and what that means for the Q1 average versus the MPC's forecast, I do think that there is scope for actually bringing in the rate cut in August itself. Basically, again, continuing with the theme of front loading that we saw in the June MPC meeting.
Okay, and Mr. Sabnavis, let's talk about the kind of numbers that we've seen both on the urban and rural front in terms of inflation, especially the cool-off that we've seen in rural inflation. Do you believe that this could make for a case for a good revival in consumption demand? Do you believe that these two could be interlinked to come to a conclusion that now that inflation has cooled off, especially on the rural front, we could see another cycle of maybe good demand coming in for consumption in the near term?
No, I think it will be to a very limited extent because see, whenever we are talking of a high base effect, let me give you an example. For example, if you're looking at something like tur dal, something which all of us do consume, we had a case where the price had gone up closer towards 200 rupees a kilogram from something like 130, 140 rupees. So it went up last year to say 200. And today, let's assume it's come down to something like 150, 160. So compared to last year, you'll say, okay, pulses prices has fallen down, pulses inflation is negative. But as a consumer, if I'm looking at all my food items which I'm consuming, where all the prices peaked and they definitely came down maybe in the current financial year. But if I compare with a base of 2023, I'm still worse off. So I think it's only at the margin that we will see that there will be a real gain. Because if I look at in terms of how have incomes moved, I'm not quite sure if the corporate sector has actually been paying those kind of increments which they did earlier of double digits. It's all been in the region of 5-6% layoffs in a number of sectors. So I'm not quite sure about how the consuming power of, let's say, the organized sector has been. And so therefore, I think if you're talking in terms of will this inflation lead to higher consumption, maybe at the margin, yes, maybe at certain segments, but not really at a generalized basis. I think what could probably be more effective is the creation of more jobs, incomes, salaries being increased across the board by the corporate sector. I think that is something which could do it. But I think job creation, which has already happened, maybe at the logistics level, maybe at the construction level, higher wages is something which could probably contribute to it. But purely looking in terms of whether inflation will be able to push up, a lower inflation will be able to push up consumption, I think will be very much limited. Because we should remember, even at inflation at 2% or 3.7% means prices are actually going up. let's not fall into this trap of thinking that inflation coming down means prices have come down. They have not come down. They're only increasing at 3.7% this year compared to maybe some 5% last year and 6% in the prior years. So we have to see how your incomes actually increase, nominal incomes increase relative to inflation to actually see how one is better off or worse off in net terms.
Right, that's a very important clarification coming in. And Mr. Sabnamis, thanks for that explanation for our viewers, because it is often misunderstood that if the inflation has come down, it means prices have come down. So as very correctly explained by Mr. Sabnamis, when there is a 2.1% number, even if it's lower than the 2.8% last year, it just means that prices had gone up by 2.8% last year and they have gone up by 2.1% this year. Only the pace at which the prices have gone up compared to last month or last year, that has cooled off. So that's a very important clarification to understand and keep in mind, viewers, when we're viewing the inflation numbers. But Aditi, let's talk about commodity inflation now. We have seen a cooling off coming in commodity prices, input costs for major FMCG companies. Crude seems to be doing very well right now, in control, given the way the geopolitical landscape is at the moment. But if we were to predict, and these things you cannot predict given the nature of certain geopolitical disturbances, let's say if crude prices were to spike up once again, what kind of cascading effect would that have on our CPI back home going ahead?
Sure. So, when we talk about crude and inflation, basically crude itself enters directly into the WPI inflation, both in terms of crude itself as well as the, byproducts. So it has a much bigger and a faster transmission impact into the WPI than into the CPI. The CPI does not have crude. It has things like petrol and diesel for transport. And the weight of crude and its derivatives directly in the CPI is lower than what it is in the WPI. Also, the price that gets taken for the CPI is basically the pump price. And as you would have noticed in the last couple of years, the pump prices have really been very, very stable. They haven't changed very much at all. And what has been happening is that the various cesses and duties are getting adjusted up and down when there is a large change in the crude oil prices. Through the indirect impact, of course, as you said, with the industrial inputs, with the fuel inputs that are used by the industrial sector, that has an impact on the other items which come into the CPI, particularly things like manufactured goods. But overall, the transmission is lagged and it's smaller than what we see in the WPI for the CPI. My sense is that in the recent kind of regime that we've seen, possibly large changes in crude oil prices are going to not lead to a change in the retail selling prices of things like petrol and diesel. Possibly the cesses themselves will get adjusted up and down so that the pump price remains relatively stable for the consumer, and also does not end up creating a lot of volatility in terms of the inflation numbers that the MPC has to take into account when they're setting monetary policy. At the end of the day, crude oil prices are pretty much exogenous to us, and I'm not sure that they should necessarily be affecting monetary policy decisions unless it has implications for serious implications for domestic demand. And if the pump prices remain relatively stable, then that actually takes a lot of sting out of the volatility in crude oil prices that, as you rightly said, are moving up and down based in large part on geopolitics, etc., and not necessarily on what the inherent global demand is.
Right, point taken. Thanks for that explanation, Aditi. Mr. Bhattacharya, coming to you, we've been largely highlighting the CPI, but we also had the WPI, the wholesale numbers that came earlier in the day today. What is your sense on the kind of number we've seen over there? Because that has fallen 0.1% compared to the rise of 0.5% that the street was largely estimating. What's your take on the WPI numbers that we've seen? Because even they have come better than estimates this time around.
Yes. So again, Aditi has explained this very well. I haven't seen the breakup of the WPI, but exactly as you said, so one of the key reasons is that the amount of imports that we have been seeing coming in from China, from Asia and other economies, there is a fear actually that many commodities are being dumped into India. So that's one of the key reasons. And of course, in the month of June, there was a drop in crude prices, so that even that would have contributed to the drop. And even electricity prices, the exchange prices of electricity, because of the rains, the good rains that we have had in May and June. Compared to last year, even that would have contributed to the fuel basket. So, I mean, we know this, but the key question is, what are demand conditions currently and expected in the future that will result in producers being able to pass on some of the lower prices or higher prices into consumer prices, the CPI index. So what are the pass-through mechanisms and given global conditions? We have seen global commodities prices come off in the near term. So how these prices are passed through and experiences in the past are really no indications of going forward now, given the completely different external situation that now prevails. We are glad that even on the producer front, prices have come down. But how that gets translated, what are the underlying demand conditions that will get translated into the consumer prices? That, of course, remains to be seen. But overall, as I said, both producer and consumer prices, again, reflecting what Madan said, prices gives us room for optimism that there is space for supporting growth without fear of overheating at this point in time.
Okay, so sounding very positive that there still seems to be space in the economy for the RBI to take in growth measures without the fear of overheating. Well, that was our roundup on the CPI and WPI numbers that we've seen today. Eye on the economy. Aditi, Mr. Bhattacharya, Mr. Sabnavis, thank you so much for joining us. Viewers, once again, let's just revisit what these numbers have looked like and sum it up for our viewers. Let's start by looking at the WPI numbers that fell 0.1% earlier today. On a year-on-year basis, the estimate was to go up. These are the WPI numbers that we are talking about. So, we're looking very positive on that front. You had India June primary article prices that fell, along with fuel, power, lighting prices that fell more than 2.5% on a year-on-year basis. Manufactured product prices, these are the only ones that rose about 2% on a year-on-year basis. While you had India June wholesale food prices that fell 3.75% on a year-on-year basis. While that was WPI, similar metrics for the CPI coming in, because you have food inflation that's fallen to a negative side, a deflation of 1%. June CBI urban inflation is at 2.5%. But well, yes, the main number, the headline number that we have been talking about, June CPI inflation has come in at 2% compared to 2.82% in May, whereas the core inflation continues to remain sticky at 4.4%, highest since September 2023. That was our coverage on the CPI and WPI. Thank you so much for tuning in to ET Now.